Hello, and welcome to the Dr. Money Matters podcast, the show where we discuss important financial topics that were never covered in med school. I'm your host, Dr. Tarang Patel. Welcome to episode 4 of the Dr. Money Matters podcast. Today our guest is Anjali Jariwala, CPA and Certified Financial Planner of Fit Advisors in Southern California, Redondo Beach. Is that right?
Correct.
Okay. Prior to founding her own firm, she worked for 7 years for PricewaterhouseCoopers and 2 years for a financial planning firm in Chicago, I believe, correct?
Yes.
Okay. And then Anjali started Fit Advisors to help physicians, mostly geared towards the wealth accumulation phase of their careers. And she knows something about physician issues as her husband is a practicing physician. So Anjali, welcome to the show, and thank you for coming on.
Thank you for having me.
So just if you could, we explained, talked a little bit about your background, but if you could go into a little more detail, that'd be great.
Sure. I started Fit Advisors a few years ago because I saw a need in the market for fee-only financial advisors, helping kind of the younger generation. So I really focus on kind of Gen X professionals, physicians who are in that wealth accumulation stage. So, they're just starting off, they're getting that first big paycheck, but they don't quite have enough assets accumulated yet to go work with one of the bigger firms. So that's where I come in and I'm really trying to help my clients from a completely holistic planning process to figure out all of their needs. And because I have a heavy tax background, I'm a CPA, I worked for PwC for a number of years. Tax planning is kind of one of the core services I do provide. And as you can imagine, physicians come out with a high income. A lot of them, if they reside in high income tax states, there's ways that we can kind of get that tax bill down is always beneficial.
Definitely. And as physicians trend towards employment as opposed to owning their own practices, the tax bills just keep going up. So good to discuss these issues because taxes generally tend to be most physicians' number one expense, more so than housing, more so than loans or anything like that. The biggest bill we pay is taxes. So I guess the first question I have is, at what point does a physician need to consult a tax advisor? When they're in residency, when they first start out, when is a good time to start the tax planning process?
So I would say it's when you feel like your tax situation is becoming more complicated. For most people, if they're, in training, doing residency or fellowship, their tax situation is probably pretty straightforward. And in terms of planning, there's not really much we can do, right? Because you're getting kind of your small W-2 income. You may or may not be itemizing. So outside of that, there's not much tax planning. So you can seek out someone to prepare your tax return if that's just something you don't want to do. But in terms of planning, there's not much wiggle room there just because everything is fairly straightforward.
Going along that line, as like we said, most physicians are becoming employed physicians. What are some tax planning strategies that you can do or they can undertake for employed physicians? Because as I understand, myself being an employed physician, there's really not that many deductions that we have.
Right. I mean, the main thing is you want to take advantage of any deferral mechanism that your employer is willing to offer. So whether it's the hospital, the group, whoever you're working under. So when I talk about deferrals, I mean things that come out of your income pre-tax. So one of the biggest things is always trying to max out on the 401k. If you work for an academic hospital, that 403b. The amount that an employee can contribute every year is $18,000. And the reason why that's such a big deal is because that comes out pre-tax. So if you're making $200,000, you put $18,000 away in that retirement account, then the amount of income that's subject to tax is reduced by that $18,000. The other item that comes out pre-tax that I always like to have my clients take advantage of is the HSA. The HSA is something that is offered if you have a high deductible medical plan, and there's IRS limitations as to what meets that definition. But essentially, if you're a family, you can put $6,750 away in an HSA, which is another deferral mechanism. It comes out pre-tax. And I actually encourage my clients to use that HSA as a vehicle to pay for medical expenses in retirement. Because most physicians, they probably have enough cash flow to fund their medical expenses through current cash flow. So the HSA is actually a great vehicle that you can invest that account. A lot of plans will allow you to invest that HSA, invest it for, do something more aggressive with it so that it can grow in retirement. And then in retirement, where your medical needs are going to be significantly more than they are now, you have a really nice cushion of money to draw off of. And all of those years you've been kind of putting that money away and it's coming out pre-tax again. So those are kind of the two big things that I always want my physician clients to take advantage of right away if they can.
And HSA, at my hospital, they just started offering it a couple of years ago. And the plan wasn't as good as some of the other retirement type of plans that they offer. The investment options weren't that good per se. But I mean, over the course of time, just the simple fact of compounding, like you said, use your own money to fund the HSA and use your own money to fund your healthcare and leave that HSA alone and let it compound for a while should make up for that.
Yes, because of that time value of money is a really big deal. And a lot of, whether it's, the HSA or the retirement plans, there always are investment options that tend to be more expensive. So I always encourage people to choose kind of the index funds. There's almost always a handful of index funds that you can use. And so I always try to, do allocations around those just because, cost really makes a big difference when it comes to how much money you're going to have 20, 30 years from now if you're investing it.
And one of the things that I've read about HSAs are that, and correct me if I'm wrong, but if you don't necessarily have to take the one that your employer offers you, the only way, is if you're giving up some sort of additional income or benefit that they'll give you from it, you can open your own HSA. Is that correct?
That's correct. So if you do it through the employer, though, that's where you can get it as the deferral mechanism, right? And a lot of companies will give you a certain portion. So that's something you probably don't want to walk away from because, free money is free money. But if they don't offer that, and, you have the ability to open up an HSA, there are, places where you can go where the cost is very, very reasonable. And if you fund it, if you're not getting kind of the deferral, then you can take a tax deduction on your return for it. Some
of the other tax deferral things that employees have, 401k you already talked about. My hospital and some other places offer a 457 account. What are your thoughts on those?
So those are great as well. So once again, it's another, kind of retirement deferral mechanism. So to the extent that you can maximize that account as well, that's great. Because, what it really comes down to is kind of how much cash you really need for kind of your current spending needs plus any kind of short-term and long-term goals you have. So if you need to purchase a home and things like that, then you kind of need that cash flow readily available so you can kind of build up that down payment or whatever the case may be. And then anything excess, I really try to encourage people to kind of max out all the retirement vehicles that we possibly can, just because most people need a good amount of money in retirement. So the earlier that you can save, once again, time value of money, investing that money really will help you in the long run. And, I've seen a handful of plans where there's also a deferred compensation option. So deferred comp is a little different in that it is another deferral mechanism. Usually I see it offered for people who are, in the much higher income bracket. So those who are already kind of putting away all the retirement to the extent the IRS limit allows, and there's still a lot of excess compensation. So then the company will offer the deferred comp. So you essentially are deferring a portion of your income for a certain number of years. And then that deferred comp will pay you back out in the future. So the goal is that you're deferring income now when you're in a higher income tax bracket, with the goal that when that starts getting paid back out to you in the future, you will pay tax on it, but hopefully you're in a lower income tax bracket. The only trade-off with the deferred comp is that it's not awarded the same protection that a 401k or retirement account is awarded. So, you just have to be mindful of that. And, if you're working for a very established group or a hospital, there's pretty low risk of that going belly up. Or that if creditors come in, kind of the deferred comp plan is part of the general line of creditors like everything else would be. So, it's just, you got to kind of weigh cost and benefits. But that's something that I usually have my clients take advantage of if it makes sense.
Okay. And so the 457 is basically a deferred comp. Is that correct?
Right.
Okay. Yeah, because that is one of the things that you should, like you said, it is potentially at risk, but it's a relatively low probability depending on the specific organization that you're a part of. So
that's correct.
Okay, good. This one seems to have come up recently on the internet. It's been around for a little while, the backdoor Roth IRA.
Mm-hmm.
So can you speak a little bit about that?
Sure. This is one of my favorite ones. So for every client that I can possibly do those for, I will. So I had a very busy December getting all of these done. So essentially, the Roth IRA is just a really great vehicle. The contributions are post-tax dollars, meaning it's money you've already paid tax on. So you contribute a Roth with post-tax dollars. It grows tax-free, and in retirement, it comes out tax-free. Because it's such a great benefit, there are income limitations. So if you're a married couple, if you make more than, I believe it's $183,000, then you no longer can contribute to a Roth IRA. So the Roth is something where if you are young, you're just starting residency or fellowship and you have that cash flow, I highly encourage people to try to put that $5,500 away. I actually would probably recommend the Roth over doing a 401k unless there's a match, just because when you're in a lower income tax bracket, that Roth IRA is actually going to be more beneficial than doing the deferral of a 401k. And once again, the earlier you start, the time value of money, that account can be a pretty decent size by the time you're in retirement. So a way that you can fund a Roth IRA if you're above the income limitation is this backdoor Roth strategy. So what you do is you essentially contribute the yearly amount, so $5,500 per person. So for a couple, it'd be $11,000. You fund a non-deductible regular IRA, and then you immediately convert it into a Roth. So because you didn't take a tax deduction for that IRA, there's no tax consequences when you convert it to a Roth. So you essentially have contributed to a Roth even though you're above the income limitation. The people who cannot necessarily do this strategy are ones that have an IRA already. Because what happens is when there's another IRA account in the pool, it essentially taints the pot so that when you're converting that $5,500, a portion of it will be taxable. So it's really great for people who maybe all of their retirement money is kind of in 401ks or 403b plans. So there's really no other IRA account. So those are like the perfect individuals to be able to do these backdoor Roth strategies.
Okay. And one of the things that if you have a small, like a SEP IRA or something like that, you can either maybe convert that and just pay the taxes on it now, or people with larger IRA balances, in theory, you can roll it over into your 401k provided your employer lets you. Is that correct?
Correct. Yes. I actually did that for two of my clients last year. They had kind of this small legacy SEP IRA, and we ended up rolling it into the 401k so that they could start doing the backdoor Roths. So that's just something, some plan documents will allow it, some will not. So it's just a matter of making sure that the plan allows it.
So we've talked about the investment portions. One of the other big tax deductions most employed physicians, or I guess most physicians in general, have is their mortgage. Basically, my understanding is your mortgage is deductible up to $1 million. Is that right?
That's correct.
Okay. And because in certain states, that's, you don't hit that number. In high costs areas such as California, where you're at, $1 million doesn't get you nearly the same amount of house that it gets you elsewhere.
Right.
And then student loans. What is the deductibility of student loans?
So you can deduct the interest from your student loans, but the income threshold is very, very low. So to be honest, I don't have a single physician who's able to deduct that student loan interest. So, student loans, it's one of those things where, that ends up being probably the biggest debt for most physicians right after the mortgage, depending on where they live. And there's just not a ton of tax planning that you can really do around the student loans. On the student loan side, it really comes down to making sure that you're on the right repayment plan that aligns with kind of your goals and needs. So whether that's wanting to pay that debt off as aggressively as possible, then you kind of go with the standard. Or if you want a little bit more leeway and have current cash flow, then you can pick maybe an income-based repayment plan instead, so that the amount of your payment is based on the income. And it would never be higher than the standard amount of payment, depending on the plan you pick, so that if you want to just maximize current cash, you can. On the flip side, if public service loan forgiveness is a really great perk that the government is offering, I believe it's this year when we're going to start seeing the first group of people taking advantage of that. So if anyone, is going to be working for, the VA, a 501c3, any sort of government hospital, if you make 10 years of qualifying payments, then your entire debt is forgiven. So really great benefit, really great perk. Anyone who's kind of going along the public service loan forgiveness type program, really work with someone who understands that program. So you're aligned with the right Fed loan service provider and that the payments are being accounted for correctly, because unfortunately, the student loan servicers are not very good with their record. So I have seen cases where they've missed payments. And especially, if you're having that debt forgiven, an extra 3-4 payments that the government thinks you need to make when you don't need to make can be a pretty sizable difference.
Right. And from my understanding, and I recommend any listeners who are interested in this to look up the specific information, but it actually applies to not just VA hospitals, but any nonprofits. So
Correct.
A lot of hospitals, if you're an employed physician from any of the nonprofit hospital organizations, you may be eligible. And it includes the payments that you've made from residency on. So
correct. Right. So most of the time, if you're in residency or fellowship, the hospital you're working for is probably an academic hospital. It's probably a nonprofit. So you've already accumulated a certain number of years of payments. So if it's only a matter of X amount more years and there's, the trade-off is that maybe the income isn't as higher as it would be in private practice. But if you have a pretty sizable loan, it's something to really consider.
Right. And the forgiveness amount is also non-taxable, correct?
Correct. So there's income-based repayment plans where the debt is forgiven after either 20 or 25 years. So if you are under one of those and after 20 or 25 years, depending on which plan you're on, if there's still a balance left, that's forgiven. But the flip side is that amount is picked up as tax. So, and they don't give you any warning that it's coming. So you'll just get the notice that it's been forgiven. And then you're going to see the amount that's forgiven show up on your tax return. So that's something to also be mindful of, especially if you have a large amount of debt and you're kind of waiting for that 20 or 25 years. If you're in a really high income tax state, let's say you're in California, when you're at top federal tax rates, you're looking at a potential 50% tax on that amount. So it might be something where you need to start saving for that tax bill now, depending how sizable it's going to be.
Okay, so now, as you've said, there's not that many tax breaks for employed physicians. But let's go to the other side of the coin, the private practice physicians, dentists. What are some of the things the advantages that they have over their employed colleagues?
Those physicians, there's a lot more tax planning that we can do. And the reason why is because that income usually will come to you as either a 1099 or if you're, a partner in the group, a K1. So you essentially have a lot more business deductions that you can take to offset that income. For many of my clients, we start looking at things that they spend money on. So, if you are someone who has to go to multiple hospitals in a given day, then we can start looking at car expense deduction. So whether we're taking mileage or the actual cost of the car. And that's where you'll start hearing people talking about running lease payments through the business and things like that. If your car is truly used for predominantly business purposes, or you can figure out the portion that is, there is room to be able to take that as a business deduction. On the other side, there's also more that you can do on the retirement side. I have a number of clients who receive majority of their income as a 1099, so an independent contractor. And because they're an independent contractor, they get no benefits, right? Because they're not an employee. So something that I've been doing for them is opening up a solo 401k. So a solo 401k is essentially a 401k for an individual who's their own business owner. And the nice part about the solo is that you can actually contribute significantly more than just the $18,000. So the limitation for the solo is $53,000 a year. And there's two pieces to it. There's the employee contribution, which is that $18,000, and then there's an employer profit sharing contribution, which is 25% of profit. So because you're essentially both the employer and the employee in a situation, you have the ability to defer $53,000 a year. So that's something that can be, really sizable, especially for people who are, there's much more income and they have all this excess savings. So that's one strategy that works really, really well. If the income is very significant, then you can start looking into cash balance plans. The IRS limitation for that is close to $240,000 a year. But obviously, cash balance plans are, there's a much greater cost to set those up and maintain because there's these requirements and rules that go into play. So it's more like knowing that there is that consistent income stream, whether the cost makes sense to be able to put more money away.
Okay. And then also in terms of the private practice physicians and dentists, do they have more leeway in terms of their medical education deductions, vacation? You hear about people taking vacations and using that as, more of a taking CMEs and then being able to use that as part of their vacations. What are your thoughts about that?
So, it all comes down to having it be reasonable, right? So anything like, CME dues, any sort of medical subscriptions, things like that, those are all very legitimate business expenses. So those are things that you can absolutely take. The CME is another one where if you're traveling to go to a conference, I know I have seen situations where people kind of extend that out a little bit so that, the flight and things like that is a business deduction because you're going to the conference, and then you can kind of write off more of the meals and things like that. So those are avenues that you can definitely use, even down to the point of if you're in private practice, meeting with maybe another couple, they're searching for a new physician, that dinner could be a business expense as well. So there's just a lot more that you can kind of help to offset that income when you're your own business owner, that you're just not able to do so if you're an employee.
Right. Yeah, I'm learning that the hard way, but no, but that's good. That's good information. One of the things that I recently did or set up is a donor advised fund, a charitable giving fund. Mm-hmm. Do you have any experience with those? Or?
Yes, I do. So a donor advised fund is essentially a vehicle to make charitable contributions from, right? So the nice part about a donor advised fund is that you actually can pre-fund the account. So even if you contribute a large amount to the donor advised fund, you're not required to distribute that out over a certain amount of time. So it's even something that you can leave for next generations. The benefit of the donor advised fund is that you get the immediate tax deduction for it. So I've used donor advised funds for clients who have a very high income year. I had a client who had a large amount of stock options vest. So we had a large amount of income. They were charitably inclined. So we set up the donor advised fund and we actually contributed appreciated stock to it, which is another great benefit of the donor advised fund. So if you're charitably inclined and you have maybe some legacy stock positions that just have a huge capital gain embedded in it, you could actually use that and donate it to the donor advised fund. And you get the tax deduction for the fair market value of that stock on the day you make the donation. And you get that tax deduction on your tax return, but you can take X number of years to distribute that money out to whatever charitable organization you choose.
Okay, right. That's one of the perks of stock options.
Right.
Not that I would know anything about it as an employed physician, but Okay, so those are the main topics. But one of the things that I think people can do from the beginning of their careers, whether it's in residency or more likely just early out of residency, is create tax efficient investing. Would you like to talk a little bit about how you would go about doing that?
Sure. When you look at kind of the investment pool as a whole, there are certain investments that are more tax efficient than others. So, most of your equity investments, so your stocks, your ETFs, they pay out dividends when they pay out income. Dividends are more tax efficient because they're taxed at either 15 or 20% versus your ordinary income tax rate. On the flip side is fixed income. So these are your bond funds usually. So bonds pay out interest. Interest is taxed at ordinary income tax rates. So that's something that is not very tax efficient. Another one that's really tax inefficient is REITs, the real estate investment trusts. REITs by law have to distribute out at least 90% of its income every year. So if you're a holder of that REIT, you're going to get all the distributions from it. So you can see capital gains, you would see ordinary income, you could see a lot of other things that make them very tax inefficient. So for usually my high income earners, there's kind of two strategies that you can do. One is to kind of invest at a household level, which is what I do with my clients. We look at the pool of money as one pot. And then making sure that those investments that are tax inefficient, so your fixed income investments, we're going to put those in the retirement accounts, because retirement accounts, you're not paying taxes every year on those. And then things that are more tax efficient, we would put in your taxable account so that you're kind of maximizing the tax efficiency in that respect. If you're not doing it at a household level, and instead, you have just one pot of taxable money, but you do want some fixed income exposure because that's kind of your risk reducer in the portfolio, you can start looking at municipal bonds. So muni bonds are exempt from federal income tax. If you purchase muni bonds in the state you reside in, so let's say you purchase Cali muni bonds in California, then those are both federal and state tax exempt. So, there's different things you can do. And people may think that it's not that big of a deal, to kind of have that, but it really is, especially once that pool of money starts to get larger. These distributions, whether it's income or capital gains, can become fairly sizable. And so, if you, once again, it's another way where you can kind of be more mindful of what you're paying tax on.
Absolutely. One of the things that I recently learned was that the taxes on investments tend to decrease our returns much more so than the fees on the investments. And we've all been hearing recently about, reducing fees, and that's a good thing. But I don't think we've heard enough about being tax efficient.
Right. And the other thing is, capital losses are a really great tax benefit that I think, unless I haven't seen people being very diligent about harvesting those, it's more like if they have an advisor in place. But, if you have investments in your taxable account that are operating at a loss, you can sell that, accumulate that loss. That loss is something that can be used to offset any capital gains that you've had. And then you can take up to $3,000 of any excess loss and offset it against ordinary income. And let's say you still have some capital loss left over, you can carry it forward indefinitely. So this was something that we did a lot in 2008 when all the markets fell and we were rebalancing portfolios. We literally were just selling out of everything. And then, you have to wait a certain amount of days before you repurchase it. But just doing that, we had clients with, some had like $1 million+ of losses, which really adds up, especially post 2008 when we had really big run-ups in the market. So, all of that tax came back, but we essentially could shield it because of those capital losses.
Right. Absolutely. In fact, there's companies now that are set up to automate that for you, but that's
right.
That's good. And one of the main things about tax efficiency is, Warren Buffett has made it an art almost, because he never distributes dividends or, returns capital in an inefficient way. And that's one of the main ways that Berkshire Hathaway has become such a large company, is because of their tax efficiency.
And it's why his effective income tax rate is lower than his secretary's,
exactly.
Which is something he always likes to bring up as well.
Exactly. Good. Okay. So very good information. One of the things that I saw when I first got out into practice was, physicians start getting targeted for investments and things like that. Well, I saw a letter from a guy an investment advisor, talking about investing in oil and gas because it reduces income tax and stuff like that. And so I don't want you to specifically talk about that type of investment, but just in general, are you seeing tax scams targeting physicians or other high-income people?
The physician market specifically, I just see a lot of people trying to sell you products, right? Whether it's an insurance vehicle, an investment vehicle, whatever it is. And the unfortunate part is that physicians go through so much education, but the education lacks kind of basic financial knowledge. So I feel like it's almost like ripe picking for these people come in and kind of sell products. I see it a lot. I see it amongst my client base where they were sold some sort of universal life policy or whole life insurance policy as a tax savings vehicle. It's not. I'm a CPA. There are much better ways to get tax savings than to pay, an insurance agent for this product that costs like an obscene amount of money. So it's a process of they've put all of this money in, and once we finally unravel it and get their money out, they've lost so much because of it. And so it's really unfortunate. It's why I'm a fee-only advisor. So that's, if anyone is looking for an advisor, I really recommend the fee only because they're actually not permitted to take any sort of commissions, referral fees, or anything else. So you know that the advice they're providing you, there's no conflicts of interest. On the investment side, those people are fine, but they're not, I wouldn't call them financial advisors. And the term financial advisor is so broad and it's not really regulated. They're really there to kind of manage your money. And I've seen a lot of times where they stick really expensive products in clients' portfolios. And most of the time from those products, they get some sort of commission. There might be a load or there might be something else in there. So maybe they're telling you that they're charging you 1%, but you're not really paying 1%. You're paying maybe 2% or even more than that. A lot of these funds that have a load, meaning that there's a certain percentage you pay to get in or you pay to get out, could be up to 5%. So, when you're really looking at it, low cost is the way to go. So if there's someone there who's kind of promising you returns and things like that, I would be very mindful of that and very wary. Because the data has shown that 85% of active fund managers cannot beat their benchmarks after 10 years, and it's because of fees. And so when you're looking at performance, you really have to look, you can't look 1, 3, or 5 years out. You really have to look long-term because it's those long-term advisors and investments that are really going to get you to where you need to be. And if you're kind of in your 30s or 40s, you have 20, 30 years of growth. So why have it eaten up in those fees and those products?
Right. No, absolutely. I think it's becoming more mainstream, this information, but not nearly enough. Even amongst my colleagues, we over the last 4 or 5 years, we've noticed that people are now starting to understand fees. And I'm hoping that things such as this podcast, a lot of the financial blogs will help distribute that message. But I appreciate you doing that as well. So I want to thank you for coming on this podcast. Really good information. Let us know where we can find out more about you and your company. And if our listeners want to speak with you or contact you, how they can do that.
Sure. I encourage anyone interested to feel free to visit my website. It's www.fitadvisors.com. I have information about my fees and my services. And there's also a contact form, so you could feel free to reach out to me with any additional questions you have.
Thank you for listening to another episode of the Dr. Money Matters podcast. Thanks again to our guest, Anjali Jariwala of Fit Advisors. She did a good job summarizing the importance of tax planning and definitely highlighted the special benefits that practice owners have over employees in regards to how much taxes they pay. A couple of quick take-home points. Anjali mentioned the time value of money. This is basically the idea that $1 saved earlier in one's life has more value than $1 saved later because of the power of compound interest. The second is to try to do your own taxes at least one time, preferably earlier in your career when your income is limited and your returns are higher. It's not that difficult with available tax preparation software, and you'll be surprised how much you are paying or possibly overpaying. You can still submit it to an accountant to verify, but I think it'll be one of the best investments you make in your financial education. If you enjoyed this podcast, please leave a positive review on iTunes, Google Play, Stitcher, and let your colleagues know about this podcast. If you have some criticism, please send an email to comments@drmoneymatters.com. Again, that's all spelled out. Please remember that what you've heard on this show is for your entertainment and education only. Speak with the appropriate experts prior to making decisions regarding your own financial situation. Thanks again, and look for our next episode coming soon.